Good morning, real estate mindset community, and welcome to another morning live. Happy Wednesday to you. Thank you for joining me so early. I don't have to, but I want to make my little boy, my son's field trip this morning, and I have to leave at 8:30 a.m. So I wanted to start early. So I'm going to get right into the market update. But real quick to WTH, I threw your comment up on the screen. If Lennar is going to give you a lesson about home ownership and being a first-time home buyer, do me a favor, brother, record it and send me the recording because I want to hear what Lennar is saying. So please, if there's any way for you to record that, please do that because I'd love to reference that in one of my videos. Now, here's where I'm going to start, guys. Let's start by real quick. I want to show you guys the letter. Let me pull this up right here. So I want to show you the letter that NAR, MBA, and NHAB sent into Jerome Powell and the Federal Reserve. This is huge, you guys, because if next time you hear cheerlead, good morning, Deuster. I see you guys. Good morning, everyone. Deuster, it's always nice, man. Now, the next time you guys hear some, market cheerleader saying now's the best time to buy, you don't know what's going to happen, blah, 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 blah. I want you to do me a favor and reference this letter because this letter is in part from the National Association of Realtors. So the realtors that are continuing to push the fear of missing out, continuing to say, just marry the house, date the rate. You don't know if home prices are going to go down. Don't sit on the sidelines. Reference this letter because their own heads of their associations that they have to join are expressing dire concerns of a hard landing in real estate. They are essentially begging Jerome Powell. And here's the letter. This letter is posted in my community section on the channel. So again, any nonsense, anyone's talking any nonsense, I want you to reference this and ask them, why does the head of your association disagree with your optimism? Why does the head of your association disagree with your optimism? I want you to ask them that. But here's a few things that I want to read, and then we're going to get started, you guys. So again, I'm just going to read a little bit of the first paragraph and the end. So this is all three associations writing into the Federal Reserve, and this is what they're saying. They're writing in to convey profound concern, okay, shared among our collective memberships that ongoing market uncertainty about the Fed's rate path is contributing to a recent interest rate hikes and volatility. But the problem here is they're so concerned about their greed that they're not focusing on what the Federal Reserve has already said about the path of the rate hikes. In fact, the Fed has not given us the path that they have said. They said they're going to be more aggressive. So the fact that these three associations, pillars of the real estate industry, don't understand the path of rate hikes is so foolish to me and naive. This is why we need a re-regulation in the industry. This is why we can't lean on any of these people. Think about that, guys. They're so wrapped up in their own business and their own corruption. They're not even warning consumers. They're begging the Fed behind our backs to save them. Do y'all understand that? This is the National Association of Realtors. So again, for all the market cheerleaders, I'm sorry, you guys, to all the market cheerleaders, but the cat's out of the bag. Your own head, the head of your body is saying dire concerns. Okay. And this is crazy. Look at what they're asking the Fed to do. Basically, two things that they're asking the Fed to do. Number one, and this is the three associations, you guys. This is crazy. They wrote this to Jerome Powell. Oh my God. It's so crazy to me. Now, the first thing they're asking is the Fed does not contemplate further rate hikes. Why? Read the letter if you guys want to. Now, the second thing, and we're going to go into this in our market update because we haven't been talking about MBS or mortgage-backed securities, but they're also asking the Fed not to sell off any of its MBS holdings or mortgage-backed securities until and unless the housing finance market has stabilized. So again, this is interesting because this is acknowledging, okay, from these huge loan officers, builders, realtors, this is acknowledging that the market's going to collapse. And they see it coming now. They see the uncertainty. Now, even if the Fed stops raising the interest rates, the short-term interest rates or the federal funds rate or discount rate, whatever you want to call it, they still have power to manipulate mortgage rates by selling mortgage-backed securities. Okay, so we don't really talk about that. We're going to talk about that now. So let's get into our next thing, y'all. I want to show you the movement starting with the 10-year. Okay, now, yesterday we did a video and I said mortgage rates have plummeted, but when I showed you mortgage rates, they haven't plummeted. So we're going to see how much they plummeted today. Because remember, we watched the 10-year and then the 10-year tracks mortgage rates. So if we want to know what's going to happen with mortgage rates today, Generally, we watch the 10-year. So when we look at this 10-year right now, you guys, the 10-year treasury, what do we know about mortgage rates? Good morning, Johnny. I see you, brother. Good morning. Nice to see you. I know it's 2 hours earlier there, Johnny. Thank you for joining us, bro. So what do we know about mortgage rates? We know that mortgage rates are going to go down today because this 10-year is down significantly. And this 10-year being down significantly today, and by the way, you guys, it ended yesterday, I believe, double-digit decline. So we had double-digit decline yesterday. We're already starting this morning. Good morning, Trey. We're already starting this morning with the 10-year treasury down 8 basis points. The reason that is, primary reason, the war. We have a second war now. And what we're seeing here is a flight to safety. Because remember, when people buy that 10-year, remember, the price goes down, it drops. So right now, people are buying the 10-year, and that's why you're seeing that drop. Okay, so does it make sense? But remember what this is as well. What is this to the economy? This is the business killer. This is the business killer. This is the long end of the yields. Okay, so this is our business and economy killer. So if you want to watch what's going on with businesses, the economy, and how much they're suffering, you're going to really want to pay attention to the 10-year. Now, if you want to look at the liquidity zapper, okay, here's the liquidity zapper, for a lack of better words. Okay, just to put this in perspective, here's the liquidity zapper. If you want to see the liquidity being taken out of the market, watch that 6-month treasury. And you're probably saying, well, what do you mean liquidity zapper? The thing is right now, guys, is we need this money to go away. Okay, this is the overnight reverse purchase account right here. And right now there's a $1.2 trillion. Now, this can be looked at as many things, but just to sum this up, this is the liquidity from all of the money printing. So we still have this massive buffer. This is a buffer. This is liquidity. So what's happening right now with quantitative tightening is the Federal Reserve is burning money. They're making it disappear. That's part of quantitative tightening. So essentially what needs to happen is this money, okay, in the reverse repo market needs to buy treasuries. And when they buy treasuries, the Fed is going to take that money from the treasuries and they're either going to spend it or they're going to burn it. So once this money is done right here, you guys, they're going to start, in my opinion, selling more mortgage-backed securities. And in turn, by selling mortgage-backed securities, that's an additional way for mortgage rates to be manipulated by the Federal Reserve. Now, one of the reasons why the money is leaving this account is because of this. Okay, the interest rate, and this is actually really crazy, the interest rate on the 1 day right now, so it's like a 1-day treasury. This is where the banks and financing institutions are putting deposits. That interest rate right now is 5.3. So on the 1 day, they're getting 5.3. But if they invest that money into this 6-month treasury, or even a 1 month, they're going to make more money relatively risk-free. And that is why you see this go down. So the more that this goes down, the better it is. So if you really want to see when, the stuff kind of hits the fan, probably it's a good idea to keep your eye on this. A lot of people are thinking this is going to be up this year. It's really going to depend on the long end of those yields and what this goes to, the overnight reverse, the award rate. So the award rate is 5.3. Okay, so keep your eyes on that. Let me show you guys mortgage-backed securities, because remember, we haven't really been talking about this. This is the other side of the quantitative tightening. Again, we haven't really even talked about this because they're not really selling at the pace that they said they're going to sell. These mortgage-backed securities, I want you guys to understand what this does. By the government, Federal Reserve, purchasing mortgage-backed securities, they're basically subsidizing home loans. So they're making it, for lack of better words, they're making it way easier for lenders to make profit. Okay? So by them purchasing mortgage-backed securities, it allows lenders to make more money and to lend easier. Do y'all understand what I'm saying? So they have a lot of mortgage-backed securities right now. And they have, basically, the Federal Reserve said they're going to start selling this. But the thing is they are selling it. You guys can see it's going down, but they have not sold mortgage-backed securities at the pace in which they have said they were. I believe the reason that is, who the heck are they going to sell the mortgage-backed securities to? Because here's the issue, you guys. And it's actually plausible that when they start selling mortgage-backed securities, that they're going to lose billions of dollars by selling mortgage-backed securities. And here's the reason why. Those low interest rates. Everyone that refinanced during COVID, a lot of that's right here, you guys. So here's all of like the low interest rates. Okay, so not all, but here's a lot of the loans with the low. Here's the golden handcuff. This is the golden handcuffs right here. Okay, so just for lack of a better word. So here's all the golden handcuff money. Who's going to buy it? There's no one's going to buy this because rates right now are 5%. Half of these mortgages are 2 and 3%. So when the Fed starts to sell this, more than likely they're going to lose money because ain't no one want to buy this. Okay. Now, what you're seeing here is not really them sell mortgage-backed securities, okay, although they are. But what's happening is instead of outright selling mortgage-backed securities, which is a packaging of mortgage loans, just to say it's a whole bunch of mortgage loans, they're letting it roll off the balance sheet, which means they let it expire and then they don't buy more. So you see this going down. But what do I mean by, what do people mean by expire? How could a MBS expire? How does it mature? Well, when someone sells their house or refinances their loan. When someone sells or refinances, they pay off their loan, right? Their loan's paid off and then you have their higher interest rate. But the thing here is, guess what's down right now? Purchases and refinances are in the gutter. So it's going a lot slower than anticipated. So I just wanted to remind you guys, even if the Fed stops hiking the short-term interest rate or the federal funds rate, they still have the ability to manipulate mortgage rates, not only with additional policies, but mortgage-backed securities. So right now we're watching this, okay? We're watching this. We're watching the overnight reverse repo market because this is a massive amount of liquidity. After this runs out, things are really going to hit the fan, and then I'll be starting to watch this, which is your mortgage-backed securities. Let me put this on the 10-year. You can see how much they have. Look at that, guys. I mean, you could also say that one of the reasons why we're in this situation is this, because they bought the mortgage-backed securities when mortgages were 2 and 3%. Okay, so whose fault is this really? I mean, is it really consumer? I mean, it's the Federal Reserve. It's the government that's doing all of this, right? So we're kind of putting the pieces together. I hope you guys are starting to see that. Hope that's just my little crash course. I got to kind of hurry. I'm really sorry, you guys, but that was my little crash course on like what's going on right now, like the liquidity. When is all the stuff going to fall apart? I mean, you guys, we're so much more equipped than we were a year and a half ago. I mean, it's completely ridiculous. So I'm going to go into our first video. And then after this video, I'm going to go into the mortgage rates and to show you guys what they're doing and what they did yesterday. But this video right here that y'all about to watch, I want y'all to comment below and let me know how you feel about it. This is going to be about affordability. Now, the person that's talking is just, they just reek of the bullish narrative. They're saying everything's okay because it's just like the 1980s. And I just want to remind everyone, and if you don't believe me, go to my playlist on my channel and go to Housing Market Update. I have a comparison of the 1970s and 80s versus today. There's nowhere near the comparison. You can't make a comparison to consumers in 1980 and today. It's nothing. There's nothing similar. Literally, there's nothing similar to consumers in the 70s and 80s versus right now. Wage growth. And then people are like, well, rates were 18%. Well, how much savings rates? Imagine the savings rates back then. So if rates were 18%, how much were they getting back on their money? 10, 11, 12%? I mean, think about it. And not only that, one thing I also want to point out about consumers that went through the 70s and 80s, their savings rate was in the double digits before and during the recession. Right now, our savings rate is 3%. And the wage gap and the wealth gap, out of control, unprecedented. So there's nowhere near the comparison. I just wanted to make that point. But you guys listen to what she has to say. Let me know your thoughts down below. And if you can, let me know that the audio is okay. I appreciate you guys and good morning. Thank you for being here so early.
America economists are nixing concerns about a housing crash like the one experienced in 2008. Instead, they say the market is more reminiscent of what played out 4 decades ago. Let's bring in Danny Romero with more on the latest warning coming out of B of A. Danny.
Akiko, Bank of America warned last week that their economists are feeling some type of eerie deja vu feeling, but not from the 2008 housing market, instead from the 1980s. Bank of America economists say that there are a few key similarities. Back in the 1980s, inflation was running high. CPI had hit 14.8% on an annual basis, leading to those years in the 1980s. And as a response, the Federal Reserve raised interest rates, which consequently caused mortgage rates to hover between 9% and 18% during that time frame. Also, it was a prime time for baby boomers to start purchasing some homes. Does that sound a little bit somewhat similar to what's going on now? And if we fast forward to today, inflation hit its highest level June of 2022. And the Federal Reserve recognized that inflation was a problem, so they increased interest rates, and consequently, mortgage rates have nearly doubled. Mortgage rates are now hovering over that 7%, hindering purchasing power for demand millennials right now. And there are still some similarities. Home prices have surged, demand has fallen, sales of existing homes has tanked. But the biggest difference between now and then is leverage. Mortgage debt to disposable income hit 65% in the second quarter of this year compared to 45% in the 1980s. That's not something to really worry about, Bank of America economists have said, because households' balance sheets are still really, really strong and they're in very good shape. But looking ahead, Bank of America expects limited housing, high home prices, and labor shortages. And also, they still say that affordability will remain the biggest challenge looking ahead. And they even said, wrapping up, that there is potential turbulence looking ahead. Akiko?
Potential turbulence looking ahead. They're just now figuring that out. So I don't know about you guys, but that is a little bit ridiculous. Okay, we just got some numbers out right now. PPI. Let me throw it up on the screen. Here we are with PPI. PPI hits 2.2% over past year, ending in September, highest in 5 months. That's not good. That means higher for longer is what's going to happen. And that's probably why. Okay, so PPI is up. That's interesting. Again, it's beating expectations. Let's see if the 10-year has made any adjustments now that we have the readings for the PPI out. So look at this. Okay, so take a look. So it looks like that, I'm assuming that PPI came out probably right around here, because look at the movement in the 10-year. It's now going up. It's just so again, we have these we have these cross currents. We have this turmoil, and yet we still have that runaway inflation. This is a crazy situation. So that means they got to continue to hurt us. So even though we're getting hurt, we're getting beat down, the inflation is still there. We know that because of shelter. I mean, who doesn't know that homes are overpriced? I mean, literally the entire world knows homes are overpriced right now. Why is that so hard to understand? Let's go into the mortgage rates right now, you guys. So yesterday we were talking about how mortgage rates were plummeted, but remember, that doesn't update till later on in the day. So and people were commenting like, what do you mean, Travis? What do you mean rates are plummeting? They're still 7.8. Well, look at that, guys. See how we stay ahead of the market? How do we stay ahead of the market? Because remember, I did that video yesterday. Rates were 7.8. They didn't appear to be changed. But when it updated, we're down almost 20 basis points. That is a massive one-day movement. If you look at the one-day movement, that plummeted. And how did we know that? How did we know it was going to plummet? Again, this is how we know. Right here. It's easy, right? You guys are getting it. This is so easy. You guys are with me on this. So again, we're watching this because that is going to affect this, the mortgage rate. So again, what's going to happen around 2 o'clock today? This is going to go down again. And that's probably going to go down. Again, it's going to go down generally faster than the rate of the 10-year. So that's going to go down probably to, well, it depends what the 10-year ends, but you guys, that's going to go down. That's going to go down a lot. It's going to go down, I'm going to say 15 to 20 basis points. We're probably going to be sitting under 7.5. I'm going to say under 7.5 today. Let me know what you guys think. But if that trajectory continues, we will be under 7.5 today. Again, in my opinion, take a look at this. I haven't showed you guys this yet. Okay. Johnny's probably like, heck yeah, I'm going to win my dollar. So this is housing inventory. This updated about when I left town. And what I wanted to show you is, this is so cool. Okay, so inventory active units right now is at 701. This is just Fred's gauge, okay? We're not talking about new construction. So look at that. We're only off now, okay? Because everyone's like, oh my God, the inventory. And I was like, one of those people like, oh, everyone's buying houses again. The inventory is going down. But now that this is updated, we now can see very clearly that we are only down from last year, 30,000 units. So we're down 30,000 active units. So that means that when this updates next month, it's possible that we finally have year over year inventory growth. That probably will happen next month. And really what's really kind of astonishing about what you guys are seeing right here is the inventory is actually going up during times when it really doesn't go up, which is the fall and winter. And anyone know why that might be? So why do you think that inventory is going up right now when historically it doesn't go up this time of year. The reason that is the interest rates and the sentiment is starting to sink its teeth in again, and buying demand is crushed. So demand is crushed enough to where we actually have inventory growth in horrible months of inventory. That's how much demand is crushed right now. So again, I keep going back. What happens when we get the inventory? Because we will get the inventory back. That's a for sure thing. We know we always get the inventory back. I've already seen this happen before. But anyways, I thought you guys would find that interesting. So we're getting inventory again. Am I going to get my dollar? I don't know. I'm worried about that. We're going to go into our second video. Do I still have time? Yeah, I still have. I'm good on my time. Second video is going to go into, the hard landing. Again, man, I mean, this is so hard. But part of the stuff that I like about this is they're acknowledging that the Fed basically printed too much money. But it's really hard to trust these people for obvious reasons. It's hard to trust the suit. So listen, and I think when you guys listen to this video, you'll see that some of these people they are intelligent. Some of these people have really great points, but like as they're making their point, they just go out in left field and they just push the narrative that they're paid to preach. And I think we see that here.
I think the Fed will keep on tightening. I mean, the economy is doing very well. We've met all their targets in terms of growth, in terms of unemployment, in terms of inflation. I think they are worried, frankly, about all this fiscal stimulus. I mean, we're at full employment. You don't normally put this much stimulus into an economy at full employment. It's kind of like bringing an extra keg to a frat party at 2 a.m. I mean, it's going to make the party louder, but it'll make the hangover worse. So they've got to counteract this fiscal stimulus. I think that's what they're going to do. So I think another 4 rate hikes in September, December, March, and June. That'll bring us up to 2 3/4 to 3% on the federal funds rate. I think, and I hope they'll stop there, because you're talking about risks. The other risk to the economy is the Fed over tightens late. Just as the economy slows down in the second half of next year, and we think it will, if they raise rates too much at that point, that could cause problems.
And what will the yield curve look like a year from now after they raise rates?
If they stop at 4, I think it'll be almost exactly flat. In other words, I think the yield on a 2-year Treasury note will be the same as the yield on a 10-year bond. If they go more than 4 rate hikes, I think we might get inverted. But people worry too much about an inverted yield curve. It is a broken barometer. It used to be the yield curve was a very good predictor of what the economy was going to do.
Used to be.
Why would you buy a long-term bond with a lower yield than a short-term bond? It's because you think the Fed's going to cut rates. Why is the Fed going to cut rates? Because the economy's in trouble. But you can't trust the long end anymore.
Why?
Well, because central banks have been buying long-term bonds like never before. And they're basically sitting on the long end of the yield curve, and that's distorting it. I mean, it's kind of like, I don't believe in torture because torture is immoral, but also a tortured prisoner is going to lie to you. The yield curve is being tortured by central banks and is going to tell us lies. Now, it doesn't mean there couldn't be problems in the future, but we're going to need a better measure of what's going on than the yield curve.
And how does an inverted yield curve affect consumers or borrowers?
Well, that's a funny thing. It is a symptom without being a disease. Because, as I said, an inverted yield curve has usually been a problem or it suggested a problem is coming because it means the Fed's worried about something. But if you think about it, American households have got about $3 in financial interest-bearing assets for every $1 they have in debt. And most of those interest-bearing assets are short-term, things like CDs. And most of that debt are long-term, things like mortgages. So if you've got an inverted yield curve, if short rates go up more than long rates, guess what? You're giving more income to consumers and you're not pushing up their expenses. It actually stimulates the economy. And that's one of the funny things. People worry about it. It's harmless as of itself. And if it doesn't work as a barometer of where the economy is going, there are lots of things to worry about, think about. I wouldn't worry too much about the yield curve.
All right, y'all, you heard it from the corporate talking suit right there that we shouldn't worry about the yield curve. I mean, that's literally, excuse me, I'm getting choked up here. He said we can't trust it, basically implied that it's been wrong. But the reality is it's been right for the last, 150 years? What the hell is this guy talking about? He's saying, so the way that this guy explained away the massive unprecedented warning signs is, we can't trust it. But to be honest with you, I would rather trust historical president than some dude in a suit. And I know maybe some people like him and that's fine, but oh my God. So we should trust him that's being paid to preach a narrative, and we shouldn't trust historical president. And let's look at the yield curves right now, guys. Really crazy video. But he was making good points about the inversion. It's just the fact that he's saying that we should discredit it is absolutely a maniac statement to say. But anyways, here's the 10 and the 2. The reinversion continues. Again, you guys, we're sitting at a 30 basis point inversion right now. This has been skyrocketing, as you guys know, since about September. It's been skyrocketing because, and when I'm saying skyrocketing, the disinversion, let's say. So the disinversion, it's not reinverted yet. It's speeding up this disinversion. But the intriguing thing here is the reason why it's disinverting right now is the long end of the yield, which is the 10-year, right? So the 10-year is ballooning up. And because it's ballooning up, it's being uninverted. So generally this uninverts because the short end, which means the Fed drops the federal funds rate, right? Or the short end of the yield. But that's not happening right now. This is an incredible reinversion right here. Very interesting, you guys, but it is continuing. We're not reinverted yet. Generally, before we enter recession, we have to be uninverted for a few months. And look at the historical precedent. So this guy's saying, again, that we can't trust the yield curve inversion. But it accurately predicts almost every single recession, especially when we look at the 3-month and the 10-year. So anyways, guys, very interesting. It's continuing the reinversion. It has not stopped. It's tapered. Okay, so here's the thing. It stopped yesterday. It's not updated yet, but you can see that it basically yesterday it plateaued. So we've had massive inversion until yesterday. So yesterday was the first day to let you guys know that the reinversion stopped. Okay. It's not updated for some reason, but I can assure you, and you can see that right here, that it actually stayed the same. So day over day, it was 30 basis points. So it plateaued, was what I'm saying. So it straight up plateaued. Again, you guys, the reason why this isn't uninverting anymore is because of this. Oh my God, did you guys just see that? It's because of this 10-year. And look at this. Oh my gosh. I just saw this positive. This is so crazy. So the 10-year is down. The economy killer, the business killer, the 10-year, the long end is down. That's the killer. But the liquidity zapper, look at this. So here's the liquidity zapper, right? It's up. That's crazy. Maybe it's a flight to the long end. I don't know, but that's insane to me. So the fact that this is up, more than likely, we're going to see this money go down. Again, the reverse repo. So let's go into our next thing, guys, which is this 5-year break-even inflation. So again, even with all this economic turmoil, what do we have going on? We just got another inflation reading. Okay. We just got the job numbers. We got so much information right now that says we still have inflation. We still need higher interest rates for longer. And this chart also tells us that this is a very important chart to the Federal Reserve. This is the expectations of inflation, 5-year break-even inflation rate. You guys, it basically ticked back up. This needs to be at 2% or under. So probably under 2% before they even start cutting interest rates. Very interesting. Very interesting. So crept up a little bit. We were basically on our way down, but then we got job numbers. You know, we got a lot of stuff out. So let's go into our next video, which is, sorry guys, let me put it up like this so that the audio is better. So our next video is going to be on the November rate hike. Okay, so this video is going to be on the fact that the November rate hike may be still on the table because we still have inflation. We still have inflation. We still have a job market that's not crippled. So they're warning that even though the market has written, I'm going to show you after this video, the market has written off the Fed. The market is saying, Fed, you're done. The market's telling the Fed, you're done. Isn't it crazy how our economy works? You guys enjoy this video.
Chief U.S. economist Jonathan Pingle. And Jonathan, you never want to root for a weak jobs report. We want Americans to have jobs and higher wages, but it does feel like that's what the market needs to see to calm down over these bond yields. What are we going to get?
Well, unfortunately, I think you're probably going to get an upside surprise. I mean, we're forecasting 200,000 gain, solid back to school, private sector looking okay, and probably an upside surprise on average hourly earnings as well. I mean, the market, this is probably going to reinforce the whole resilience theme that I think, the market's having a hard time digesting at the moment.
So what's that going to do? You think it's going to spark another sell-off in bonds?
Yeah, I mean, if you continue to get the strong data like this, we're going to look ahead to the CPI, which probably matters a little bit more than payrolls. But, you get a slew of strong data here. I mean, you could very easily put a November rate hike back on the table for the FOMC. I mean, we're expecting a 23 basis point increase in core CPI next week. But, if it comes in at, say, 0.30, which is a normal forecast error or higher, that's going to look like you've had an acceleration in core CPI from July, August to September. If that's coming along on the back of, a really solid employment report, I mean, the data-dependent FOMC is going to end up having to have that discussion about, hiking again, which was their base case in the September summary of economic projections, and potentially as early as November. I mean, that's not our forecast, but you get strong enough data, and they're a data-dependent committee.
Yep.
So, I mean, I guess we should talk about, Jonathan, why this is happening. I know there are lags on Fed rate hikes. I know we had a lot of excess savings from COVID, and we had a lot of behavioral changes. People went out, they traveled, they saw Taylor Swift, and all of that has helped the economy remain resilient. But what is it? Why is it hanging in there so much to the point where many on the street are still not expecting a recession, which is now presenting a big problem for the bond market?
Yeah, I mean, we would chalk it up to really, first of all, the consumer's been super resilient. When we look at the labor market has really basically just moved in line with output growth. So it's really this sort of strong spending and output growth that has, also allowed the labor market to chug along too here. So, and when you decompose like what's really supported consumer spending, you've just gotten a lot of support from, the wealth, savings, and credit. Household balance sheets were in tremendous shape. There was a ton of excess savings. We would estimate there's, still excess savings sloshing around. And you certainly, house prices have hung in there, and until, really the last few weeks since the September FOMC meeting, equity valuations have held in there. So you've had a consumer that has had, a lot of support here and has really powered the expansion along.
We're showing the 2-year, 10-year spread.
Okay.
This is the yield curve.
Stimulus.
This is what everybody's glued to. And something interesting is happening, Jonathan, which is that it is uninverting from its deep, deep negative levels. It's still negative, but traditionally, that's a sign that the recession is more imminent. Correct? Is that something you see happening as a result of the action in the last few days and weeks?
So, we still have a recession in our baseline projection, but I will say market sentiment has swung substantially the other direction towards really ongoing solid growth over the next few years. And you can see that in the FOMC's economic projections as well, where they basically got really fine GDP growth for basically four straight years in their projections. Now, I think what's happening on the long end of the curve is a little bit more than what's happening at the very front end, where you've got the Fed rate hikes being priced in. Further out the curve, our Treasury strategists have done some nice decompositions where you are seeing this real slump in demand. At the same time, we do have a deficit problem and a certain amount of ongoing supply concerns. But certainly the combination of this slump in demand for Treasuries, along with the signals out of the Fed 2 weeks ago for higher real rates, has certainly pushed up the long end of the curve and added a certain amount of term premium further out. That's undoing some of that inversion.
All righty, guys. So we got super strong consumers here. You know what? What I like that he was saying is there was too much money printed. So I think he hit that right. Here's where I differ from people's opinion. When people say the economy is strong, the consumer is strong, I think that they're only saying that because of the stimulus, because of the money printing. It makes it appear that consumers are strong, but reality is the government just printed money. People took the money and they either spent it or a lot of them paid off their debt. So now that money is gone, their debt has been reset. They're right back into the same lifestyle. In fact, it's probably a lot worse now because it's probably a considerable amount of people that were depending on the Fed. When someone gets, when someone's life improves, when they can lean on something to help them, it's kind of what I'm saying is kind of an addiction. And it's not really fair because our leaders know that. They know that about consumers. They know everything they're doing. They're playing us like a bunch of chumps, quite frankly, in full. So let me show you guys now the market, okay? The market right now is, let me show you what the market's thinking is going to happen. So the market's disrespecting the Fed. Just so everyone is clear, the market thinks that the Fed is weak. They think that there's still a Fed put. They think they're done with interest rate hikes. Okay, so they're pretty much writing it off. I'm sorry. But look at December, you guys. December, oh, it went up. Actually, it went up because the PPI or we just got the inflation reading. And by the way, you guys, the PPI, just so you guys know, let me throw this up here first, and then we're going to go into the rates because this all just shifted. This all just shifted now because this is what happened. Okay, here's what happened today. So now there's the market once again is slightly pricing in a second rate hike in December.
Producer price inflation comes in a little.
The expectation was 0.3. So the expectation was 0.3. It came in at 0.5. So it came above expectations. So when I first looked at this was like at 20%. So this has gone up to about 30%. But what I want to do, remember, we want to look at mid next year to get an idea of what's coming down the pipeline. So you guys know that I'm looking at July. I always look at July and June. So July, it's only giving us a 19% chance of elevated interest rates, meaning what rates are right now are higher. And June, this went up. This is good. June is at 35%. Before that updated, this was worse, by the way. So I don't have much to say, but at least it's a little bit more in line. I'm just kidding, you guys. That's not in line at all, but at least they're pricing in a little bit more. The market is foolish. The market is so foolish here. All right, let's listen to our last video. Really appreciate you guys. Really nice to see everyone. I see Jeff. I see Johnny. I see all of my friends. And I just wanted to let you guys know this real quick, and I'm going to prep this last video. Okay, how do I want to say? This is what I wanted to say. As a content creator, as someone that's on YouTube, that's a normal person, I just wanted to say thank you to you guys, because you guys are helping me grow. I want to let you guys know, keep commenting, keep giving me your opinions, your insights, your criticisms, all of that stuff, because I was thinking last night just how blown away I am on the growth that I've made, not only as in real estate, but I'll shut up. I'm so sorry. But as a man, you guys have helped me become a better person. So I just wanted to say thank you. But here's our last video. This is about the Fed pivot.
And UBS chief U.S. economist Jonathan Pingle. And Jonathan, you never want to root for a weak jobs report. We want Americans to have jobs and higher wages, but it does feel like that's what the market needs to see to calm down over these bond yields. What are we going to get?
Well, unfortunately, I think you're probably going to get an upside surprise. I mean, we're forecasting 200,000 gain, solid back to school, private sector looking okay, and probably an upside surprise on average hourly earnings as well. I mean, the market, this is probably going to reinforce the whole resilience theme that I think, the market's having a hard time digesting at the moment. So
what's that going to do? You think it's going to spark another sell-off in bonds?
Yeah, I mean, if you continue to get the strong data like this, we're going to look ahead to the CPI, which probably matters a little bit more than payrolls. But, you get a slew of strong data here. I mean, you could very easily put a November rate hike back on the table for the FOMC. I mean, we're expecting a 23 basis point increase in core CPI next week. But, if it comes in at, say, 0.30, which is a normal forecast error or higher, that's going to look like you've had an acceleration in core CPI from July, August to September. If that's coming along on the back of, a really solid employment report, I mean, the data-dependent FOMC is going to end up having to have that discussion about, hiking again, which was their base case in the September summary of economic projections, and potentially as early as November. I mean, that's not our forecast, but you get strong enough data, and they're a data-dependent committee.
So, I mean, I guess we should talk about, Jonathan, why this is happening. I know there are lags on Fed rate hikes. I know we had a lot of excess savings from COVID. I know we had a lot of behavioral changes. People went out, they traveled, they saw Taylor Swift, and all of that has helped the economy remain resilient. But what is it? Why is it hanging in there so much to the point where many on the street are still not expecting a recession, which is now presenting a big problem for the bond market?
Yeah, I mean, we would chalk it up to really, first of all, the consumer's been super resilient. When we look at the labor market has really basically just moved in line with output growth. So it's really this sort of strong spending and output growth that has, also allowed the labor market to chug along too here. So, and when you decompose like what's really supported consumer spending, you've just gotten a lot of support from, the wealth, savings, and credit. Household balance sheets were in tremendous shape. There was a ton of excess savings. We would estimate there's, still excess savings sloshing around. And you certainly, house prices have hung in there, and until, really the last few weeks since the September FOMC meeting, equity valuations have held in there. So you've had a consumer that has had, a lot of support here and has really powered the expansion along.
We're showing the 2-year, 10-year spread. This is the yield curve. This is what everybody's glued to. And something interesting is happening, Jonathan, which is that it is uninverting from it.
All right. So we kind of heard all of that as a little bit of a repeat, but anyways, y'all, that's my presentation today. A lot of crazy stuff going on. Still a lot of people kind of all over the place. Let me bring up some Q&As and then I got to get out of here for my boy. And also that's why I just really want to thank you guys because you're allowing me to spend time with my family. I want you to know that. Thank you. Okay, so a few comments. Let's throw up this comment first. Okay, so this is from Matt. This is Matt. Looks like he's a veteran. Appreciate your service, Matt. Definitely appreciate that, man. If you are a veteran, definitely appreciate all of our veterans. Every veteran should be treated with respect and integrity, and people should accept VA loans, in my opinion. So I just wanted to say that first. But he's basically saying the stock market is fine, economy is fine, there is no crash coming, and I think he's serious about that. And Matt, I just want to say I appreciate your opinion. Wish we had some context there, but what I want to do, Matt, if you can, I'm not sure if you're a realtor. I don't want to go on some bashing rant about realtors, but if you could, Matt, go ahead and go to the community section. If you have time, go to the community section of my channel and look at the letter that the National Associations just wrote to the Fed. So if you're a realtor, I'm not saying you are, I don't know if you are, but if you are a realtor or if you're a loan officer, your own associations are scared about the crash that's coming. Your people, but again, I don't know if you're a realtor or not, but I would strongly encourage you to see what the National Association of Realtors, Mortgage Bankers Association, and the National Home Builders Association are saying because they have dire concerns. Pretty important, just saying. But thank you for commenting, man, and I really mean that. I really mean that because these people, they're respectful. If you guys are respectful, please share your criticism with all of us. So here's a comment from Deuster, the #1 OG first place comment champion. Ford just took out a $9.2 billion loan for claiming that is for electric car development production. And he's going on to say that there's a trend here because every single time there was a major recession, they took out a major loan with some bogus excuse. So maybe that's another warning sign of a recession. I mean, there's so much writing on the wall. But, like what people with Matt, I mean, we don't have a fortune. We don't tell fortune here. We're using the data and the historical precedent to be cautious. I mean, we're literally using the data. Anyways, here's from Ray. Does anyone think prices will fall below what they were in 2020? And the reason I brought this up, you guys, this is so important to me. You have to understand it depends. I think in some metro areas, for sure it will. In some metro areas, it's already under 2021. So in some metro areas like Austin, we're already there. Actually, that's 2021, not 2020. I'll go back and double check, but in some places we're already there. Here's what I want you to know, Ray. Remember what I'm always saying about how real estate is local. In fact, let's just say, unless you're rural, farmland, acreage, but like normal, most places, real estate is about subdivision, okay? Real estate is about subdivision. So it's so localized, you have to look at comp and sold data in the subject property subdivision. So I don't know, Ray, but here's what I want to challenge you. I want to challenge you to do your homework. I want you to get with, if you're a realtor, access MLS. If you don't have a realtor or you don't have access, get with a realtor. Have them do a market analysis based on price and based on the rental market in the subdivisions that you want. Because Ray, I can guarantee you, you don't even know what 2020 prices are, do you? You see my point, my man? So I want you to, maybe you do, but this is to everyone. It's not just you, Ray. I don't even know that you know what 2020 prices are. In my market, I know what 2020 prices are, 2019 prices are, 2021, 2022, because I really want to buy a house really bad. It drives me crazy, but I am so in tune with my local housing market. It's not even funny. I lose sleep over it. So it's already dropping under 2020 in some places, but not in all places. Oh, Albany is one place. My gosh, Albany. And I know there's a lot of crime there. So here's a comment from Matt K. With world geopolitics circling the drain, I think everything will change for super bad. I'm very pessimistic right now. So I just wanted to remind you, back during the great financial, listen to me, so important. During the great financial crisis, GFC, we had the world to bail us out. We had the world to bail us out in many ways during the great financial crisis. Right now, we don't have that. The whole world is in a similar situation that we were in during the GFC. Like Canada, Australia, they have adjustable rate mortgages. Canada right now is doing loans that are being negatively amortized. The whole world has a GFC right now, like we had in 2009. We have something different. I think right now, certain things are worse than 2008 for sure. And if we talk about unaffordability, and if we talk about the prices of houses being so overpriced, it's worse than 2008 from the data. It is a fact. Some things are worse, but what is better? Let's be realistic. What's better than 2008? Lending guidelines. Okay. And what do I mean by lending guidelines? Income verification. That's it. Income verification. That is the primary difference. Income verification. Plus the second thing is loan modification, or rather the lack of foreclosures. Those are the differences. But again, the lack of foreclosures, why do we have the lack of foreclosures? They just banned foreclosures for 2 years. It takes time for that to build up. Sorry, I went off a little bit on the deep end right there. From A Hill, but real estate agents everywhere are acting like none of this is happening, and you should buy at the artificially elevated rate. They are holding houses on the market. So again, anyone that sees that from a realtor, I want you to reference, if you can, this right here. Reference the letter that I put in my community section. This is from their own associations acknowledging dire concerns about market stability. They won't tell us that, you guys. They won't tell us that, but they'll pencil in Jerome Powell and they'll tell each other that. So again, realize all of those associations, they probably got in a room and they're like, oh my God, we're concerned, we're worried, blah, 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 blah. But they didn't tell us that. They didn't tell us that. Does that not drive you guys crazy? It drives me crazy. Anyways, here we go from Night Cree. Appreciate you, brother. So why is there hundreds of millions spent on a Taylor Swift, always mentioned as a strong consumer indication? Because consumers can relate to that. So when you have these people in these suits talking about Taylor Swift, they're like, oh, everything's okay because they can relate to us because we like Taylor Swift too. Everything's going to be okay. Just saying. You guys, they're explaining away the yield curve inversion by saying that it's not been right and we can't trust it. But then the reality is it's been right. Almost when we look at the 10 and when we look at the 10-year and the 3-month, it's always been right. We got some problems right now. And I hope you guys are starting to get a handle on the fact that there's a lot going on right now. And a couple of things I want you to take away with this video. Number one, there's a lot going on right now. A lot of headwinds going on right now. Number two, we're not done. We are still on the plane ride. There's still a future of economic turmoil that we don't even know about yet. It's coming. It's close. We have the uninversion happening. We have the bankruptcy, every line of bankruptcy, the defaults, we got so much going on right now, but it's not broken yet. It's not completely broken yet. And that's why consumers are falling for the fear of missing out and going to purchase. So right now, I want to leave you here, you guys. 2 things I want you to do, okay, for today, maybe throughout this week. I want to end on 2 words, okay, to take with you throughout today. There's 2 things I want you guys to focus on. Number 1, patience. Number 2, caution. Those are great attributes. Don't get bullied. Don't be ashamed for being on the sideline waiting. Understand we are doing the right thing. My parents trained me this way. This is my morals. This is my integrity. The harder we work, the better reward we get. The more disciplined we are with patience, the bigger the reward. Not a second do I think that that's all going to be replaced by a premise that the government is going to pay for me to live. I don't think the government is going to pay for me to live. I think it's my responsibility to have a happy and healthy life. And I also believe it's your responsibility. Now, the Federal Reserve makes that very hard, right? But they don't make it impossible. So don't give up hope, because that's what they want. Trust me on that. Now, other than that, guys, if you're out there investing in real estate, I wish you luck. I'm going to go run over to spend some time with my son. I love him very much. And if you're out there investing in real estate, I wish you luck. And I hope you